Hello and welcome back to another video here on the ComLucro channel. Today we're going to walk through a multi-time frame masterclass showing how structure develops from the weekly chart down to the 60-minute chart and how these layers reveal clear trading opportunities. In this video, you will learn how the weekly chart sets direction, how the daily chart highlights the key zones, and how the 60-minute chart gives you precise execution timing. You will also see two powerful entry models you can use today, including one with a risk to reward of 1 to 4, the kind of precision traders spend years trying to master. Together, fair value gaps, order blocks, changes of character, and Fibonacci retracements reveal the areas where price is most likely to react. These insights form a simple and repeatable blueprint that helps you trade with clarity and stay aligned with the true intention of the market. So if you like this kind of video, please like, subscribe, and turn on notifications. And join the ComLucro community to support the channel and keep improving as a trader. Before we begin the chart breakdown, here's what we're going to study in this Euro-Dollar masterclass. First, we will look at the weekly structure to understand the dominant direction of the market. Then we'll move into the daily chart to identify the key points of interest that shape the next reaction. After that, we'll drill down to the 60-minute chart to time our execution with precision based on liquidity and structural flow. Inside this study, we will also build two practical entry models. The first is a daily-based entry that reacts to the 50% level of the fair value gap and offers a risk to reward of 1 to 4. The second is a 60-minute entry that waits for a confirmed change of character before positioning, providing a tactical option for intraday alignment. By the end of this video, you'll have a complete multi-time frame blueprint, along with two entry methods you can apply with confidence. Now we're going to start looking at the charts, and the pair we're analyzing in this study is the Euro-Dollar. Before we begin, keep in mind that every number I mention, such as weekly higher high number 4 or weekly higher low number 3, is simply a reference point to help you visualize the chart more easily. These numbers do not carry any meaning beyond guiding you through the structure shown on the screen. As we move into the weekly chart, we start to see the broader structure that shapes everything happening on the lower time frames. The story begins at the weekly low number 1, the moment when the market finally stops falling and creates the first potential shift in direction. From there, price expands upward and delivers the weekly change of character number 1, confirming that buyers have stepped in and taken control by breaking the previous weekly structure. After that, the market continues pushing higher into the weekly high number 2, establishing the first major peak of this new bullish cycle. Next, the market retraces and forms the weekly higher low number 3, a clean pullback that keeps the weekly trend intact and shows that demand is still active. From this point, price begins a new bullish leg that drives the market into the weekly higher high number 4, leaving behind the weekly break of structure number 2 and reinforcing the continuation of the trend. If you want to strengthen your ability to read this type of market structure, I recommend watching the video from our Smart Money course called the Ultimate Market Structure Masterclass, available in the description. At the top of this push, we have the weekly higher high number 4, together with the weekly possible break of structure number 4, which signals a possible structural shift, but still requires confirmation. The chart also highlights the weekly order block number 3, the zone that originated the main bullish displacement, and remains an important reference point for deeper retracements. In this specific movement, which is the leg from the weekly higher low number 3 up to the weekly higher high number 4, price has already retraced beyond the 38.2% Fibonacci level, which, according to our ComLucro rules, is enough to classify the correction as valid. Price is now approaching the 50% retracement of this leg, moving closer to the discount zone where deeper reactions often occur, although it is still positioned above the weekly order block number 3. With that in mind, the most important movement for our analysis is exactly this leg between the weekly higher low number 3 and the weekly higher high number 4. Since this is where the current retracement, the Fibonacci levels, and the potential structural shift are all developing. Now on the daily chart, we begin our analysis at the daily higher low number 1, the point where the market confirms short-term strength and begins building the internal structure that supports the larger weekly trend. From this higher low, the market expands upward and delivers the daily break of structure number 2, which shows that buyers gained momentum inside the daily flow and pushed price above the previous short-term high. After this expansion, price continues climbing until it reaches the daily higher high number 3. This level becomes a key reference for the bullish leg that follows. Once price reacts from this high, the market begins to pull back, and during this movement, we mark the daily failed change of character number 2. This shift is considered failed because after the attempt to break below the previous structure, price does not produce a break of structure to confirm the reversal. For a change of character to be valid in our ComLucro rules, it must be followed by a break of structure. Since that confirmation never appears, the bearish attempt is invalid and the bullish structure remains intact. As the pullback continues, the market finds support at the daily higher low number 4, which forms the base for another upward movement. From here, price pushes again and reaches the daily higher high number 5. This daily higher high number 5 is the same point as the weekly higher high number 4, meaning both timeframes align at this structural extreme. At this same level, we also find the weekly possible break of structure number 4 and the daily possible break of structure number 5, both signaling that a potential structural shift may occur if price confirms with continuation. During this phase, we also highlight the daily fair value gap number 4, an inefficiency left behind during the bullish displacement. If you want help identifying fair value gaps correctly on your own charts, I suggest watching the video FVG Explained, How the Best Traders Spot Precise Entries, which is linked in the description. Beneath this gap, we also mark the daily change of character number 4, the level where a confirmed shift in daily momentum would take place if price breaks and closes below it. Finally, we approach the daily order block number 4, the key daily demand zone that sits above the larger weekly order block number 3. This alignment between daily and weekly demand strengthens the narrative because price is pulling back into an area where the higher time frame already suggests discount conditions. As price approaches this zone, the daily structure prepares for the next decisive reaction, setting the stage for continuation or reversal inside the weekly context. Now we move to the 60-minute chart, and at this point, we will look for 2 different types of entries that align with both the daily narrative and the intraday structure. The first type of entry comes directly from the daily context. When price taps the 50% level of the daily fair value gap, we prepare a buy order targeting the order block on the 60-minute chart that created the last change of character to the downside. With a stop loss placed just below the daily fair value gap, the risk to reward becomes 1 to 4.80. If we choose a more conservative stop, placing it below the daily order block, the risk becomes higher and the reward becomes smaller, reducing the overall efficiency of the setup. The second type of entry is more aligned with the internal structure of the 60-minute time frame. Since price has already tapped the daily fair value gap, we will now wait for a confirmed change of character to the upside on the 60-minute chart as a condition to open a long position. Once this shift is validated, we enter the trade, placing the stop loss below the swing low that forms the change of character. The target, once again, is the 60-minute order block that caused the last bearish change of character, creating a risk to reward of 1 to 1.9 and offering a tactical intraday entry that respects the structure of this time frame. And as we finish this study, it's important to note that every entry model we outlined here reached its target with precision. Both the daily-based entry and the intraday 60-minute entry delivered clean reactions and completed their objectives, showing how structure, alignment, and clear execution rules can lead to consistent and profitable outcomes. This reinforces the power of reading the narrative correctly, understanding where the market is seeking liquidity, and waiting for your conditions instead of forcing the trade. Before we wrap up this analysis, notice how the euro-dollar structure becomes even clearer when you understand the relationship between order blocks and fair value gaps. We saw how the weekly chart sets the context, the daily chart refines the key zones, and the 60-minute chart gives us the execution. But knowing where price might react is only part of the puzzle. The real challenge is knowing which zone has the higher probability and why price respects one level while ignoring another. To make this even clearer, I'm going to play a short clip that shows how price interacts with fair value gaps and order blocks, and how structural shifts guide the best entry choice. This will reinforce the logic behind the entries we created and show how the same principles repeat across different markets. Let's take a look. In this video, you will learn how price behaves around order blocks and fair value gaps on different time frames, how to identify which zone carries the highest probability in each scenario, and how inefficiency and liquidity voids influence entry precision. You will also see how changes in character and structural shifts guide the selection of the best entry method. These insights form a practical decision-making blueprint that helps you avoid unnecessary refinement, improve your hit rate, and stay aligned with the true behavior of price as it moves between liquidity pools and mitigation zones. So let us begin. As you already know, order blocks and fair value gaps are two zones that smart money traders rely on when setting their entries in the market. Still, many traders struggle to understand which of these areas carries the stronger probability and is more likely to be respected by price. In this example, the market reacts to the higher time frame order block, but ignores the lower time frame one. This reveals an important insight. When price repeatedly fails to reach your entry, it often means the setup has been refined more than necessary. That clip reinforces a core principle that connects directly with everything we mapped out in the euro-dollar analysis. Your entries only make sense when they align with the broader market structure. When you understand the trend, the leg we are in, and the liquidity price is targeting, it becomes much clearer whether the reaction will come from a fair value gap, an order block, or if price will simply skip both on its way to the next level. Traders who combine structure with clear entry models consistently choose higher probability zones and avoid the losses that come from over-refining or selecting the wrong area. With the structure and entry logic now aligned, the entire narrative of this move becomes far easier to read and execute. Please also remember that our mission here on the ComLucro channel is to give traders the clarity and confidence they need to make smarter decisions in the market. Every video, every course, and every piece of content we create has one clear purpose: to deliver practical, easy-to-apply knowledge that helps you grow step by step as a trader. Here on the channel, you'll find complete courses on smart money concepts, technical analysis for day traders, and trading psychology. Because trading isn't just about charts, it's also about mindset, discipline, and risk management. We also share lessons and insights from some of the most respected names in trading, professionals like David Paul, Alexander Elder, Tom Hugard, Mark Douglas, Al Brooks, Larry Williams, and many others whose experience has shaped the way we understand the markets today. If you enjoyed this video and found it helpful, please give it a like. It really helps more traders discover our content. And don't forget to subscribe and turn on notifications so you never miss our latest insights and strategies. If you'd like to go even deeper and access exclusive content, early video releases, and additional tools to support your development, consider joining the ComLucro trader community right here on YouTube. It's a simple way to support our work and a smart investment in your own growth as a trader. Thanks for watching, and I'll see you in the next video.